Silver has recently been much weaker than gold,
Mhm.
starting to show turning signs for us as well. And I think that once gold crosses that threshold of 2,500 and suddenly people realize it wasn't a top, that's when the money flows start to get aggressive. And anybody who wanted to sell silver has probably already done it. They're either short or they're out, in which case, if you go back up, you're going to have a lot of short covering and you're going to have a lot of guys who got out saying, gosh, I made a mistake.
Mhm.
And I think that the wild dog will slingshot again, leading gold this time.
Many market participants are watching gold's potential bullish breakout to new record highs. Gold broke out of a long-term basing pattern in March and continued to strengthen. Renowned financial analyst MichaelOliver mentions that his bullish outlook on gold has remained steady since 2016, noting that the recent pause after hitting $2,450 in April is significant. Oliver predicts that silver will also surge once gold breaks above $2,500, driven by short covering and renewed interest from investors who previously exited the market. Gold has seen its best performance in decades in 2024, amid its climb to a new record high of $2,483.35. While the yellow metal has struggled to rally above $2,480 on 3 separate occasions, one analyst says it's only a matter of time before it succeeds and breaks above $2,500. According to MichaelOliver, the gradual upward trend of GDX is set to shift into a rapid ascent if it surpasses the $40 mark. He foresees a significant acceleration in its momentum, potentially leading to a swift breakthrough of the previous high of $46.50. Based on the share price being above its 5, 20, and 50-day exponential moving averages, the current trend is considered strongly bullish, and GDX is experiencing buying pressure, which is a positive indicator for future bullish movement. VanEck Vectors. Gold miners find support from accumulated volume at $36.87. And this level may hold a buying opportunity as an upward reaction can be expected when the support is being tested. Several short-term signals, along with a generally good trend, are positive, and the current level may hold a buying opportunity as there is a fair chance for VanEck Vectors Gold Miners ETF to perform well in the short term. Now we present the clips of MichaelOliver's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
We turned aggressively bullish again on gold. Not that we were ever bearish. We turned bullish in 2016. Gold was 1140. Our long-term view has never changed. There have been big sell-offs. We know that, but it's still a major trend. This pause that we've had since the April high in gold, when it got up to about 2450, you've eked out some marginally higher highs, but the price chart is to keep risking that 2500 level. Now, again, we're talking the front month contract, so we're talking October gold, which is below 2,500. Everybody looks at D gold, but October's the front traded contract. We'll rotate the December future in our analysis once we get into October, the delivery month. But that contract continues to be sold just short of 2,500. It actually isn't just a price level. We have momentum trigger levels that assert that the recent range action we've had in gold, which has been fairly benign, will start to explode again if you get much above 2,500. I've got a whole cluster of momentum-based structures that are breaking out there, not just the price going to a new high. So it's for real. You get above 2,500, expect acceleration. And at that point in time, I'd expect the wild dog silver market to suddenly do just the opposite of what it's done recently. And, if you look at silver since the beginning of the year, for example, gold peaked, well, it didn't peak. It stopped going up in mid-April. Look what silver did after mid-April. It shot up another $2, $3. So it's much stronger than gold after the April high, whereas gold plateaued. Now silver has recently been much weaker than gold, starting to show turning signs for us as well. And I think that once gold crosses that threshold of 2,500 and suddenly people realize it wasn't a top, that's when the money flows start to get aggressive. And anybody who wanted to sell silver has probably already done it. They're either short or they're out, in which case, if you go back up, you're going to have a lot of short covering, and you're going to have a lot of guys who got out saying, gosh, I made a mistake. And I think that the wild dog will slingshot again, leading gold this time. Well, by the way, watch the gold miners too. They're doing quite well. GDX has, if you'll look at it, it's been zigzagging upward while gold plateaued. The high, it'll back off pretty seriously. Never go. Our original re-entry level on GDX was back in March at 3150. We said at that point it's going to accelerate. Well, it shot up to 37, backed off 38. And the recent highs have been 39. Right now we're in the mid 37s, I think. Okay.
Great
Coming
call.
back up. I've got some renewed trigger levels on GDX that say probably acceleration, dramatic acceleration in the advance. No longer this arm wrestling stuff. If
Wow.
you get up above 40 by just a bit, we get very specific in our reports, but it's just above 40. Now, the old high in GDX, again, the high back in 2020, the gold was already, 2070 in price. GDX was 4650. Now, if you ever clear that, people are going to get excited, but I'm going to say this. If you get much above 40, you're going to clear that, and you're likely to clear it in a heartbeat and go zooming past it. In other words, I don't think it's resistance. I think we'll just go zipping through it. The trigger level's just above the recent highs we've made, so just above 40.
During the interview, MichaelOliver suggested that a Fed rate cut may soon be on the horizon. However, this shift would be positive for gold. He parallels past instances where shorting stocks and buying gold and bonds after a Fed rate cut proved profitable. Highlighting a pivotal shift, he observed a significant momentum breakthrough in T-bonds, signaling an upward move in bond prices and falling yields, aligning with gold and diverging from recent stock market behavior. On top of that, interest rate cuts in the U.S., when they materialize, will push down bond yields and mean a weaker U.S. dollar. These factors could make gold more attractive, with gold prices tending to move in the opposite direction to U.S. government bond yields and the U.S. dollar. Analyzing the dollar index's technical analysis data, Oliver notes that after a year of stagnation, it is now approaching a critical point. He predicts that a close below 102 could trigger a sharp decline, significantly influencing other markets. Let's get back to the interview.
So they're ready to shift. And, whether they do it before September or not, being the Iron Man that he is, he probably doesn't want to do that because it would look like he's spooked by something. I know what he's going to get spooked by the way, the banking sector, which is not having a good bounce, by the way. But forgetting that, we have the rally right now, and let's assume tomorrow is a good data point. There'll probably be more rally. If you see that rally peter out in the stock market, like, you get a good day tomorrow, and then suddenly you close with a wobble, maybe up but off the high, and then next week you've got nothing. If you see that kind of response, then effectively what the market's done is it's priced in the rate cut. Now, if you go back to the top in 2000, 2001, and the top in 2007, circle when the Fed shifted from policy prior rate increases and then a pause, and then they cut, circle the point where they cut. And if you shorted then, you did quite well. The Fed cutting rates is not a good sign. There's a party going on. Now, at the same time, it's our view fundamentally, and we're technicians, of course, but gold is driven by monetary excess, which is an ongoing process, decade after decade. The monies degrade because they increase the money supply, they cut rates below what the market might otherwise, et cetera, et cetera. It's just a constant fuel. So a rate cut shift now for gold, positive, and it's not a failing rally. Just like in 2001, if you shorted the S&P and bought T-bonds and gold, you made money both sides. 2007, if you shorted that Fed rate cut in September 2007, the market peaked a month later. Gold and T-bonds continued up while the S&P went down. I think we're in the same position right now. There was a while back over the last year or two where T-bonds were tending to move with gold, meaning price, not yield, but price moved down with gold. If gold went down, price of T-bonds rally if gold rallied. Then they divorced themselves recently, and the T-bonds remained under pressure while gold shot up here since March. Because the T-bonds were capped off, and they tried to go back to that October low of last year and couldn't do it, but they were capped off while gold broke out. So to some extent, the linkage that we saw got divorced. But now they're back in link again because the T-bonds, via our work using quarterly momentum, again, is measuring price versus, let's say, a 3/4 moving average. The oscillator broke through a massive basing action at the end of last month. Price of T-bonds then were about 120. Right now we're trading with 124, 25. We got up to 126. So I think the T-bonds have now shifted in a mega way, indicating their next significant move is up, drop in yields. And it's coincident now with gold, inverse to what the stock market has just recently done. Dollar index has been a non-event for well over a year, ever since it collapsed from that 115 high down into the 90s on dollar index itself, cash. And then it's oscillated in about a 7-8% range, trendless. And therefore, who cares, right? Wasn't having an influence on any market. A month ago, we started to break some long-term metrics and just around the 104 level, just above 104. Now it's down in the 102 level. You close out a month at 102 or lower, and it's going to accelerate on the downside. So suddenly at that point, this other asset category, money, the major currencies we're talking about now, because the dollar index is mostly the inverse of the euro and the yen, combined. But you break that dollar index down about a half a point below where it's trading right now and close a month there or lower, any month in this quarter, this month or next month. Expect the downside of the dollar to make some noise, in which case you have a new variable out there that will affect the other markets.
Gold's bullish outlook stays strong, with analysts expecting it to keep climbing despite ups and downs. Key drivers include rising demand, thanks to lower tariffs in India, and central banks continuing to buy gold. There's talk that gold prices might hit or even break past the $2,500 mark, as gold remains a go-to investment in uncertain times. Will these trends lead to a sustained rally in gold and related assets? Or are we on the brink of unexpected market dynamics? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.